Good evening and welcome to November 15, 2021 Blue Ribbon Pension Review Committee meeting. To help slow the transmission of COVID-19 and protect the health and safety of the community, City Council as well as Board Commission meetings will continue to be closed to the public for in-person attendance. The public is encouraged to watch and participate from the safety of their homes to practice social distancing. Meetings are broadcast live on Glendale TV, viewable on Spectrum Cable, Channel 6, and AT&T Uverse, Channel 99. Meetings are also streamed live in high definition on the city's webpage, glendaleca.gov/live, on youtube.com/MikeGlendale, and on Apple TV, Roku, and Amazon Fire devices using free app called ScreenWave and choosing Glendale TV from the menu. For public comments and questions during the meeting, please call 818-937-8100. Public comments on a specific agenda item will be taken when that agenda item is discussed. Now I'm going to conduct a roll call.
$1 billion to lead.
Comedian,
Yeah.
Committee Member Bain,
Present.
Committee Member Kedikian,
Present.
Committee Member Manning,
Present.
Committee Member Macias,
Present.
Committee Member Michaels, Committee Member Michaels, Crown Michaels,
Present.
Committee Member Mulano,
Here.
Committee Member Nelson, Committee Member Wolfson,
Here.
Committee Member Finch,
Here.
Committee Member Wenz, Committee Member Zakarian,
Here.
Committee Member Paulos.
Here.
Great. Item number 1, regular business agenda. 1A, the agenda for the November 15, 2021 Blue Ribbon Pension Review Committee was posted on November 12, 2021 on the bulletin board outside.
Vlad, you're cutting out.
Item number 2, oral communications. At this time, we have no callers. Item number 3 on the agenda, minutes. 3A, approval of minutes from the November 1, 2021 regular committee meeting.
Do we have a motion to approve the minutes? Mr. Milano.
Thank you. I want to once again attempt to correct the section having to do with Percival wages and the tie-in to the PEPRA changes. So we tried a couple of times before. I want to see if we can get it right the next time in case somebody reviews the minutes. My statements on 2 separate occasions have been about the fact that we may have a potential huge obligation with PEPRA because the limit on the taxable wages that are considered for the pension is tied to the Social Security taxable wages that may change in Congress soon. And so if the limit is somewhere around 140,000, 150,000, I don't know the exact number. And if that changes, then any salary would be then subject to CalPERS pensions. And so it does not limit it. And I think that is until we get some advice from an attorney or someone else who can tell us whether PEPRA is under a huge potential obligation if Congress changes the Percival taxable wages tied to the Social Security. In other words, they would have the opportunity to change the taxable wages limitation and increase it. And if so, the PEPRA conditions will change as well with it. Anyway, I just wanted to see if I could get that clarified on the minutes.
Ms. Wolfson.
Muted. Okay, there we go. Thank you. I just wanted to also say one of the comments that I had on there, I don't think it's exactly accurate. I actually had not proposed, I proposed that committee members be able to make comments and ask questions at the top of agenda items rather than at the end of presentations. So I just wanted to clarify, I think it said something like, I asked, it was kind of a little bit vague. So I'd appreciate if that was just clarified a bit. Thank you.
We'll do so.
Thank you. I presume you're going to mute me again, or am I going to mute myself now?
We will mute you.
They, yeah. All right, any other changes to the minutes? If not, can I have a motion for the minutes as amended? Alan,
So moved.
do we have a second?
Yeah, we're down right now in South Carolina where
I second.
masks are very optional. I'm used to LA where
Vlad, can you call the roll, please?
Committee Member Almeida,
all right.
Okay.
Committee Member Bain,
Yes.
Committee Member Kadikian,
Yes.
Committee Member Manning,
Yes.
Committee Member Macias,
Yes.
Committee Member Michaels,
Yes.
Committee Member Molano,
Yes.
Committee Member Nelson, Committee Member Wolfson,
Yes.
Committee Member Finch,
Yes.
Committee Member Vance, Committee Member Zakarian,
Yes.
Committee Member Paulos,
Yes.
Great. Next on the agenda, item number 4, action items 4A, public comments by committee members.
Okay, this this doesn't mean quite what it looks like it means on the agenda. This was my opportunity, and I think Ms. Wilson may want to respond. We had an issue with, there were a couple members of this committee who were addressing the city council. I wasn't going to call you out, Ms. Wilson, but you've identified yourself, so I will. In the course of that, Ms. Wolfson identified herself as a member of the committee and said a number of things that I think could be construed to an observer as speaking for the committee with respect to the adoption of an MOU. And I did want to, and this got raised to me, by the way, by a number of members of the committee who were concerned. And I did want to secure everybody's agreement that at least until we have some findings of the committee to talk about, that no one on the committee would purport to speak for the committee. I realize this may have been a little inadvertent, but you know, I think it's very, very important for our process that we not be portrayed as having taken an active role, especially in something like the adoption of an MOU. And so I would like to secure everybody's agreement that they will not attempt to speak for this committee unless they're authorized by the committee to do so. And Mr. City Attorney, would you like to add anything to that?
No, thanks, John. I think you covered it all. Again, just to make sure when you're speaking, just to speak, make sure you're speaking for yourself and not for the committee.
And now, Ms. Wilson, you wanted to respond, so.
I did. Thank you very much for the opportunity to say what I had planned to say, whether or not this was raised at tonight's meeting. I want to acknowledge I made an error in identifying myself as a member of this committee, and that was my mistake, and I apologize for that to the rest of the committee. However, having said that, I do stand 100% behind everything else I said that evening to the City Council. And I do want to say we are here on behalf of Glendale's taxpayers to thoroughly understand the city's pension liabilities and to write a report that will explain these liabilities clearly to the city residents and other stakeholders. And hopefully, if there's something that needs to be suggested with respect to the liabilities in order to ensure the city's sustainability and to protect everybody involved, to propose legally and morally defensible solutions. And I am very qualified for this committee because I am a former municipal employee in finance. I'm a CPA with many years of experience auditing and advising clients on tax and financial planning matters. And I've read many comprehensive annual financial reports of cities. So I'm also familiar with how commissions are supposed to operate, and I do mea culpa for my mistake, and it will not happen again. However, I have to say, as a member of another commission, we don't set any time limits on our commission meetings, and we all listen respectfully to every question and comment that our fellow commissioners have. And I did expect that to be the same process that we would follow here. And I'm glad that all of the committee members want to selflessly serve the community. But if any of us are not willing or able to put in the time and effort, then maybe this is not the right committee for
Okay, Ms. Wolfson, I think you're kind of getting beyond the scope of what we're trying to talk about.
I'd like to finish, if you don't mind. I want to say that I have enormous respect for the city residents and the rest of the community, and I'm sure that they'll be able to understand the pension liabilities. But we have a lot of work to do, and we have so little time. And so I want us to devote our time as much as possible to that. Thank you.
Right.
That's all I have to say.
Thank you, Ms. Wilson. Are there any other comments from committee members on this issue? If I don't hear any comments, can I assume that everybody is willing to commit to, well, let's put it this way. If you identify yourself as a member of the committee, you need to say you're not speaking for the committee. Preferably, it'd be better to not identify yourself as a member of the committee because you don't have that problem. But is everybody willing to commit to that for the future? Yeah, thumbs, great. Okay, excellent. Thank you. Okay, Mr. Milano? Not calling you out, but are you good with that?
Yes, absolutely.
Okay, good. All right. And Mr. Bain?
Yes.
Thumbs are good, by the way. Mr. Kadiki?
Yes.
Okay. Mr. Amirian?
Yes.
Okay. Mr. Zakarian?
Sir, I was actually trying to raise my hand. I apologize for that. I had something that I wanted to add, if that's okay with you.
It is. This is the time to do it.
All right. Well, number one, I'd like to thank everybody for spending the time. I know it's not easy, especially on evenings, as I have 2 children and a sick wife right now that I'm dealing with. But thank you for your apology, Mrs. Wolfson. I think it takes a big person to acknowledge the mistake that they've made. I acknowledge that. I see that, and I believe so does everybody else. And I think that's a big move towards where we go as a committee from here on out, understanding that we're all going to make mistakes and it's okay. And as long as we learn from them, it is a big deal. I do want to continue to say that, we are an advisory committee, and what we say here does count to what people see. We are trying to get our public to come in and call. So what we say, whether it be in a meeting or at a city council meeting, these things are affecting who we are and what we do and how people perceive the actual entire committee. So I believe that going forward, we should just keep moving and acknowledge the mistakes we made and go towards a good future. Thank you.
All right. Thank you, Mr. Zakarian. Any further comments? Okay, I'd like to move on. We are lucky, we really are very lucky to have Mary Beth Redding for another session. I wanted to talk a little bit about how oh, I'm sorry, Mr. Kadikian has his hand raised. My bad. It's very hard to see. These hands are really small in the picture.
Thank you, Mr. Holtzman. Actually, I had some public comments about the committee member, and it's not about that issue, but I figured I should make comments because I watched the executive committee,
Yes.
and I wanted to make some comments about the executive committee meeting. And in particular, I had submitted my request for agenda items, and I did not see or hear or raise anything in that regards. In particular, like Mr. Kadikian had requested 2 agenda items. Could we have an upvote or downvote on it or anything like that? I had sent the email, which was distributed to the members, and it's at the bottom of this. Maybe it's going to be coming up again. But my only concern is when committee members submit agenda request, at least there'll be a vote on it, even if it's a no vote. And that was one of the conditions which we requested with regards to the executive committee. So my email that I had submitted is at the bottom of the items here. Committee member submissions. There's the email from Mr. Kadikian there
Yes.
on that. And that was submitted to the executive committee for agenda item. And nothing was heard about it, nothing was discussed about it, which is a concern of mine. So I'm not sure if the executive committee has a procedure on getting agenda items on it, but we want to make sure that doesn't happen again. And I still would like my items to be considered.
Absolutely. And actually, a couple of them are already on my list as well. So, but we will make sure that we raise this at the next executive committee meeting. I apologize. We have plenty of things to cover in the meantime. Mr. Milano.
If I may, I'm sorry, Mr. Holtzman, if I may, Mr. Gadikian, I believe your email came in after the executive committee had already met, if I'm not mistaken. I could be wrong. But
No, it was emailed before, and I believe Mr. Holtzman distributed to the executive committee the day before or something.
I'm sorry. We will take action on those, and there will be plenty of opportunity. So we are also going to have somebody from CalPERS. I'm also working on a critique of CalPERS. Not personally, but a person to critique CalPERS as well. So that's not everything on your email, I understand, but there are a number of those things. Mr. Milano.
Thank you. I just want to tell Mr. Kadikian that I did bring up the letter.
with time.
Beg your pardon?
Making love with time.
Mr. Zakarian, I think you might not be. No, you are muted. Sure, what happened there? Okay. Can you try again, Mr. Milano?
Yeah, I want to reassure Mr. Kadikian that I did bring it up at the executive meeting. I think that procedurally, we need to have, should we say, a mention of all of the different documents and comments that have been submitted. I know I have submitted quite a few, but ideally, I'd like to see the committee at least hear an excerpt of the topic that I'm bringing forward for future discussion. Today, we have a response from the finance director. I'm glad that she responded quickly with the documents that I requested. But many of the topics that I brought up, along with Mr. Kadikian's letter, have not necessarily been brought forward. And I know that, Mr. Holtzman, you have a big agenda with regard to the people that you're bringing in. I appreciate that. But I think the rest of the committee should be apprised of the topics that we're bringing forward that we may think are relevant for the discussion. Thanks.
Thank you. Mr. Manning.
I just want to point out that number 6 on our agenda tonight is requests for items on future agendas. So just because something wasn't discussed by the executive committee doesn't mean that it can't get on a future agenda. We have an item tonight to discuss that. So if somebody wants to bring an idea up tonight, there's an opportunity.
Thank you. So let me do this. Actually, before we start, Mary Beth, John, you guys were going to respond, I think, to an issue that was raised by Ms. Wolf today. Is that correct? I may be looking in the wrong direction. Maybe it's Michelle.
No, it's okay. You're looking in the right direction, kind of looking at the screen, right? We're all on the same page here. Yes, I'd be happy to try and respond to Ms. Wolfson's comments from, I believe it was the last meeting, as well as I know this question or comment has come up during city council meetings as well. And it pertains to whether or not the city picks up or pays the employees' share of PERS contributions or not. And we have repeatedly said that that is not the case, that the city does not pick up the employees' share of the PERS contributions. And at the last meeting, I had asked Ms. Wolfson to maybe help point us in the right direction in case there was a miscommunication somewhere or a document that stated otherwise. And I want to thank her for sending that document over earlier this afternoon. We did take a closer look at the GMA MOUs this afternoon, and there is a section in there where it could be reasonably misunderstood, perhaps, the way that it's written, where under section C1, the heading is employee PERS contribution rate for all managers. It states, it is understood that the employee contribution rate is added to salaries by the city and shall be included in all salary and compensation comparisons. What that's intended to read, and it's always been this way, is that the employee contribution rate is a part of someone's salary. Not that it's added on top of someone's salary, but it comes directly out of someone's salary. So in all genuineness, I think it would be probably more accurate if that statement was to read, it's understood that the employee contribution rate is included in salaries paid by the city. So to reiterate what we've said before, the city does not pay the employee's share of PERS contributions. There was a second portion of the question, and if we went down, I think it was just another page. It was page 32 and 33, and actually 34, which was missing in the document that was sent to us. There is a chart that shows that employees for sworn police managers and sworn fire managers actually don't pay any share under certain circumstances. I want to take a quick moment to try to explain what this is all about. These are charts that were established many, many years ago when the MOUs were adopted. And that was, they were created at a time where the city was superfunded. There was the employer share of PERS was at the 0 or 1% level. The negotiation at the time had essentially said that if the employer rate is anywhere goes anywhere from 1 to 4%, the employee would not be paying any portion of that employer's share. However, if it went to 5%, the employee would pick up 0.5%. If it went to 6%, the employee would pick up 1%. All the way up to, if it went up to 40%, the employee would pay up to 3.5% of the employer's share if you were a sworn police manager. In the instance that you were a sworn fire manager, you could pick up to 4.5% of that share. So in all reality, I mean, I look at Matt to help me remember when the last time we were anywhere, south of maybe 40% or 30, well, say 40% in PERS contributions. But we haven't been, and employees have essentially been paying their full rate ever since this was implemented. Does that suffice, Ms. Wilson? Does that make sense? I'd be happy to try to explain a little differently, or maybe have Matt try to do it in a different way.
I was waiting because I wasn't sure if Mr. Doyle was going to jump in or not. I guess I'm still a little bit confused because it says employee contribution, not employer contribution, but maybe.
Well, I can say that I can maybe say that we're talking about two different things in the two responses that I gave you. The first one is the employee contribution. That represents the 8% that the employees automatically pay. The second response I gave you is really related towards the share, the employer's share that the employee picks up.
Okay, so the table that I had excerpted on pages 32 and 33, and I guess it continued on to 34, even though it says at the top, employee contribution example, you're telling me that that's not the employee contribution, it's the employer contribution?
No, it's the employee contribution to the employer share. It's referred to as a cost share. That's how you can tell it from the employee contribution. It's essentially employee contribution and then cost share. So this is basically showing that, yeah, that sure, if we were paying 5% for CalPERS, employees would be paying nothing on the cost share.
So
But they'd
this
still be
is-
paying for their employee share.
So in a larger picture, it's talking on the larger picture about the employer contribution.
That's right. And
Gotcha.
right. And because we're not at 0% or 5%, we're up in those bigger numbers. You're at the maximum.
Thank you for that explanation. I appreciate it.
Mr. Milano, briefly, please.
Thank you. I'm assuming that many people who may be watching these proceedings may somehow believe that there is a cost that the employees are bearing with regard to the pension. And I would say that's a bit of a misnomer. Because if the city gives an employee his paycheck and puts it in his left pocket, and then the city takes additional funds and put it in his right pocket as his long-term pension, the employee is receiving everything coming from the city. If the employee then takes some of that money from his left pocket, 10% or 9%, and puts it in his right pocket, still is the money going towards his pension and his benefit. I just want to make sure that the public doesn't think that there is some expense that the city is having for which the employee is paying. He's actually contributing towards his own pension, a portion of it. And I hope I'm explaining that correctly for the layperson. Thank you.
Okay.
Well, if I may, Mr. Holtzman, I would add that that's very similar, if not exactly the same as Social Security, where there's an employer portion and an employee portion that they contribute towards their benefit. So that in a sense is pretty much equivalent to that.
And Mr. Holtzman, if I may maybe just try to address that as appropriately as I can as well. I think the first section that we read, it was section C1, essentially had a second portion, and it read that it is understood that the employee's contribution rate is added to salaries by the city and shall be included in all salary and compensation comparisons. What that essentially means is that we include the employee's 8.5% as part of the total compensation that an employee gets from the city of Glendale. That is part of, I'm going to use a round number, not that everyone gets $100,000, but if you have an employee who makes $100,000, 8.5% comes out of that automatically off the top to go towards their employee portion of the PERS contributions. That does not mean that there is an additional 8.5% that we include on top of the $100,000 to make our employees whole. When all said and done, an employee typically at the end of the year pays about 30 to 33% of their own individual PERS pension plan from their salaries.
To be a miscellaneous employee, I assume.
Yes, miscellaneous employees.
Yeah.
Okay, what I'd like to do, because we can cover this when we don't have Mary Beth waiting, I'd like to move to Mary Beth. She is going to
John,
present.
can we have Vlad read that into the record?
I'm sorry, yes, please, Vlad. Go.
Mr. Holtzman, before we go to action item for number B, we do have a caller on the line. He's been waiting for 20 minutes. How many minutes would you like to give to caller?
Let's take the caller now so we can.
3 minutes, John?
3 minutes.
Mr. Moyle, you're on air. Mr. Moyle?
Good evening, committee members. My name is Mike Mohill. I have been following the committee from day one, and I do not like how one committee member in particular on the so-called Blue Pension Committee is performing. Our pension liabilities and obligations are going up every year with no end in sight. This committee, can't see my writing here. Let me let my wife read it. I have some vision. Okay. Let her start from the top, please.
Okay. May I start from the top again? Hello?
Let's start.
Hello? Hello?
Okay.
Blue Ribbon Pension Committee. I have been following this committee from day one, and I do not like how one member in particular on this so-called Blue Ribbon Pension Committee is performing. Our pension liabilities and obligations are going up every year with no end in sight. This committee is stacked heavily with union sympathizers and 4 union city government associations. This particular member is Zare Amirian, who was appointed by the longest-sitting politician on the dais, Ara Najarian. Since elected in 2005, politician Ara Najarian, the so-called Republican, a rhino, has ruined our city finances by approving every year outrageous salary increases and pension benefits. Mr. Amirian, you are absolutely not qualified to be on this Blue Ribbon Committee. You are not a lawyer and not a CPA or an accountant. You are a gym owner located outside the city of Glendale. This in no way is meant to demean gym owners. You do not come prepared for this committee. It is very obvious to the public that you are not prepared to find a solution for the pension crisis. It is obvious by the questions you ask that you have not read the comprehensive annual financial report of the city prepared every year. This committee must get rid of our pension crisis and the corrupt CalPERS benefit system, where the taxpayers are on the hook for their failed investments. This committee should have a bond to get rid of CalPERS and not a bond like the city of Pasadena, which is a liability against the taxpayers in order to pay city union employees salaries and benefits. This committee is about pension reform, and the city union representatives should not be on this committee. This is called the fox guarding the henhouse. Mr. Zare Amirian, I would hope you would do your homework before attending the Blue Ribbon Pension Committee meetings. Thank you very much.
Thank you, members. I have glasses. My glasses are really bad tonight, so I asked my wife to read for me. Thank you for allowing her to speak. Thank you again.
Thank you for your call, Mr. Moyle. Next on the agenda, item 4B, inclusion of presentation from Mary Beth Redding.
Okay, thank you, Vlad. So what I was going to say is Mary Beth's going to finish her presentation, focusing on some of the things we can do, and then after that, she'll take questions. I have a number of questions though that I'm going to use the chair's privilege to ask her first to try to direct some of the issues that have been brought to me by other people on the committee, and try to work on that a little bit. So Mary Beth, thank you for coming back. We appreciate not having scared you off.
Thank you, John. I'm very happy to come back. I wanted to, if I can, since everyone else is asking for favors, just take maybe 15 seconds to address Mr. Milano's question he raised during the minutes. Is that okay?
Yes, in fact, I was going to ask you about that, so that's great.
Okay, so the question was about the PEPRA pay limits. And if you go back to actually the law, the PEPRA law, it says very clearly that that limit was established January 1st, 2013 as, tied to the Social Security limit. But after that, it goes up with CPI, the US city average. So after that, it's no longer tied to the Social Security limit, and whatever Congress does with the Social Security limit is not having any bearing on the PEPRA limits.
Thank you for clearing that up. We really appreciate it. And you have also sent me an article on this, which I will distribute to the committee.
Thank you. Okay, So now I'm going to share my screen. I'm going to jump back into where we were last time. Let me share the right thing. Okay, did that work?
It did, I think. I'm seeing it in the corner of my screen, but there we go. That's better.
Okay. So I want to just start with a little recap of where we ended last time, which is the unfunded liability that we have right now, $645 million. Right now being June 30th, 2019. And what it would have been under CalPERS rules if you wanted to terminate the plan, they would have asked you for somewhere between $2 billion and $2.8 billion, likely more now. And so they're just really big numbers. The interesting part that we never got to last time was what can you do about that? And that's where I wanted to start this week. There aren't a lot of good options. Potentially you could borrow money and pay off some of these liabilities, but it still kind of falls into the same category of solutions that we have. The issue is that you have this unfunded liability with CalPERS. Right at this very moment, they're charging you 7% interest on that unfunded liability. So the way to save yourself money involves paying it down sooner. Okay, if you pay it down sooner, the amount of money that's unpaid and that you're getting charged interest on is lower, and so you end up paying a lot less interest, and that saves a lot of money. If you paid the whole $645 million right now, you wouldn't pay any interest in the future on it, and that would be great. There's still risk involved relating to investment return, but you'll see that all the solutions involve ways to pay more money sooner. One of the options is, well, let's just set aside city funds to do that with. They are restricted in what the city can invest in into things that are very, very low risk and essentially don't earn anything, any sort of investment return. So that tends to be not a very good solution. Okay. So ways to get money, either find the city may have money set aside that it wouldn't, well, it would mind, but would be feasible to pay to CalPERS right away to pay down some of the unfunded. You could borrow, you could bargain with employees to pay more money, although the amount of the unfunded we're talking about is many, many times as the city's annual payroll. So, you know, it's hard to put a big dent in that via employee bargaining. But all of the solutions will come up with somehow getting your hands on more money and doing something with it right away. Okay. Ways to get money, I mentioned borrowing. A lot of people are very interested in pension obligation bonds right now. It's usually what we call an interest arbitrage, meaning that you're borrowing in the fixed income bond market, where at the moment rates are low, although people are expecting them to go up. But that's sort of a fixed income sort of market. And then giving the money to CalPERS, who is going to invest a lot of that in equities, and in the long run should earn more money. It's not guaranteed. There is a lot of risk involved. Some people are doing smaller things like what we call one-time payments. So it would be asking the city council to make a resolution. So when there's money, you know, sometimes they have money left at the end of the year, just committing to put a certain portion of that into pensions. Even better would be just to build some extra funding into pensions. So there are ways to kind of find little bits of money. If you have money, then what can you do with it? And there's really two big categories of it. And I'll talk first about the option of giving this money, either a lot or a little, however much you can find, directly to CalPERS. Our firm believes that in the long run, that's probably going to have the best investment return. So wherever you put the money, the best investment return you can get is going to lower your long-term costs. We think CalPERS will likely have the best long-term returns because for one thing, they're a public company. They're not making a profit off of investing. Most of the other investors are charging higher expenses because they're building in profit for themselves. There's a lot of economies of scale. It's really hard to invest the kind of dollars they're investing. You know, you can't just open an account at Fidelity and invest that kind of money. So we think, again, in the very long term, not necessarily in the short term, that's probably the best investment return. But anytime you give money to CalPERS, it's not like you can treat it like a bank. You can't put the money there and say, CalPERS, you just invest it and keep track of it. And when we want to spend it, we'll let you know. You have to spend it right away on a way you agree with CalPERS. So we'll talk about how that works. One option is to do this thing CalPERS calls a fresh start. We've talked a lot about the unfunded liability. There's a lot of pieces of it. They're all getting paid off over different amounts of time. And while they're unpaid, you're paying interest on the unfunded liability. So this thing called a fresh start basically consolidates all those pieces of the unfunded liability into one new unfunded layer and pays it off over a shorter time. So it's kind of like you're taking a 30-year mortgage and refinancing it over 15 years, okay? It's a shorter period of time, there's less interest, but it's not like, you know, usually when you refinance your mortgage, you're getting a lower interest rate if you do it for a shorter time. That doesn't happen. So because you're paying in a shorter time, you will pay less interest in the long run, but in the short term, your payments go up. Most agencies are not willing to commit to that because what CalPERS has said, if you sign up for this and you don't like it, you can never go back. It's possible to sort of do this on your own with your own administration and kind of replicate that without officially signing it up for it with CalPERS, and that is an option, although it's difficult. What's much more common are these things called additional discretionary payments, which are just like what they sound like. It means you use your discretion, the city uses its discretion and sends CalPERS some extra money. What CalPERS does with that money, again, they don't save it up like a bank. They use it, sort of spend it to reduce your payments. So what CalPERS says is, oh, look at that. We have more money than we expected to have this year. So Glendale, you can pay less next year, and you can pay less the year after that and less the year after that. So you're kind of using that money over time, starting right away. It doesn't all end up, you know, making the unfunded liability get paid off faster, although because you have more money sooner, you're saving interest. There's a lot of different ways you can have CalPERS apply that money, sort of reducing your payments more sooner or more later. You can even do a lot of, again, work on your own outside of CalPERS to continue making extra payments and not let it reduce your contributions. So when CalPERS says, oh, look at that, they paid us extra money, Glendale, you can pay less next year, the city could choose to say, no, we don't want to pay less next year. Here's how much we think we would have paid and pay extra. So that you don't let your contribution decrease and you end up sort of saving that money and earning even more on it. I know that's kind of complicated, but that's in general how it works. Whenever you give CalPERS extra money, they're going to try to reduce your contributions going forward. That kind of like spends some of the extra money you gave them, but you do save a ton of interest over time. Okay. The second class of things you can do is to set up your own supplemental trust, sometimes called a 115 trust. This is a separate legal trust. It's separate from CalPERS. The city would set it up and put money aside in that trust. Okay. The only thing money in these trusts can be used for is either to make payments directly to CalPERS or to reimburse the city for a payment the city just made to CalPERS. So again, it's a way to save more money sooner. If you do that, the Section 115 trusts are advantageous because they can invest in anything the trustee thinks is fiduciarily responsible. So they can invest in mutual funds and stocks and bonds and things like that, whereas the city is not allowed to invest in those things. The city or whoever is named as the trustee of this trust would be the entity responsible for picking the investments. So it could be, sort of, you could choose how risky or potentially lucrative these investments would be. But remember, the trust, it is a fiduciary trust. It's governed by the fiduciary rules. You can't go crazy. The assets in these trusts do not account for GASB financial accounting, although they are an asset of the city. These are very, very popular. There's well over 100 of them, probably more like 200 of them now. There's a few outside providers that specialize in setting up these trusts and running them for people. And CalPERS has also established a trust that's fairly conservative that people are investing in. So why are these trusts so popular? They're much more flexible. The city would get to decide if it's going to put any money into a trust in a given year, when that's going to happen, and how much money would go in. And then once money is in the trust, it's the city that gets to decide when money is going to come out of the trust, going to CalPERS, how much it should be, and or is the money just going to stay there for a little extra time? So people are using these trusts usually have one of two strategies in mind. Either they're working very hard to reduce the CalPERS unfunded liability, but want to keep control of the money for a while. So they're just trying to send a lot of money to this 115 trust and let it accumulate. Other people are really aimed at stabilizing their contribution rates. So they are trying to build up a pot of money and use it to smooth out the fluctuations we expect in CalPERS's rates. So in a year when rates that you're owed to CalPERS spike up, you would make some payments from the trust. And when rates are lower, you would put money into the trust. So it's really a budgeting tool. So the 115 trust is very, very flexible, and you can do with it what you want. And we do recommend a lot of planning when people set up a 115 trust to really try to plan out how much money you think is going to go into the trust. And more importantly, what do you intend to do with the trust? And, you don't want to let the money sit there forever. At what point, what would trigger giving money to CalPERS, or what would trigger using that trust money to alleviate a budget issue? So if I compare the two strategies, and these are really the options you have with, however much money the city can find. There's the supplemental trust, the Section 115 trust, or there's making additional payments to CalPERS. And we do a lot of modeling of these, and the models, show that you'll get some savings. But in my experience, decisions are usually made by factors that are not the numbers. And most importantly, the first two rows here. If you give the money to CalPERS, what is happening to that money is decided upon and locked in at the moment you give the money to CalPERS, and you can never change it. With a supplemental trust, you're setting money aside in a pool, and the city really has a lot of control over exactly when and how that money is spent and applied towards pensions. Although remember, it can only be used for pensions. So supplemental trust is much more flexible. Likely, we think that most of the supplemental trust providers are going to have a little bit lower long-term returns than CalPERS, if only because most of them are privately held companies that, have some profit built into their fees. With a supplemental trust, the city has a choice of how that money is invested. It can be more conservative if you want, or less conservative. It's up to the city or whoever the city delegates that decision to. With CalPERS, you have no choice. That money is part of the CalPERS trust, and it's going to go wherever the trust is. In terms of the financial reporting, the money given to CalPERS counts as a pension plan asset. A supplemental trust does not, although it's a city asset. And, when you're reporting out to the public, the city can say, well, here's our net pension liability under the GASB rules, but look, we've set aside all this additional money. And that's usually looked on favorably. Most people reading the financial statements who care about these things would add those two numbers together in their heads. Supplemental trust is more visible. It's really easy to see the progress you've made as a city in setting aside money to be used for pensions. When you give the money to CalPERS, it's there, but it's harder to point to particular dollars and say all our hard work made that happen, because it's blended with all the rest of the money. So these are very sort of subjective considerations, but they end up being very important when people are deciding how to approach paying down the CalPERS liability. Okay, so that is the end of the slides I had to go through last week. And questions, John, you were going to start.
Yeah, I'm gonna start off. So the putting aside for a minute whether the city could pay for it, is termination likely to be a good financial bet? And let me fill that in a little bit. So our current unfunded liability is 645 in this slide, so it's gone up from there, but it's not that much higher. You can see termination. It says 2.8 million at 1.75. They're not even paying 1.75 now, so whatever.
It's a really big number.
Right, it's a big number. So here's, if you get a pension obligation bond, for example, and you pay off your 645, just boom, just pay it off. I would assume if you're trying to assess, the difference between that and termination is fundamentally when you terminate, there's no risk that if CalPERS subsequently loses money, that you have to put more in. You're just done. 2.8 billion, but you're done. And so I guess the question is, help us assess as between, say, paying off all that liability or terminating. What objective criteria can the committee use to make these assessments? Hang on a second.
So I like to think of this sort of, first of all, order of magnitude. How big is this number? It's a big number, right? I think, John, you told me the city's budgeted revenue is sort of on the order of $250 million a year.
Let's sit with John. John, what is your revenue, your general fund revenue?
Yes, it's about that.
Okay. So if you were talking about, if the city was talking about just paying off $645 million, it would take all the money the city has for like 2.5 years to do that. The city couldn't do anything else, couldn't pay anybody, couldn't do anything, but could pay off the pension liability. So that kind of gives me a picture in my head of how big that liability is. The termination liability is kind of like 10 years or 11 or 12 years of the city's revenue. It's a really big number. Something certainly not feasible for the city to do short of a really big borrowing. And I can't answer the question of, could you actually borrow that much money? Would anyone lend that to you? I don't know. But supposing, and if you were to terminate, it's really nice to think that CalPERS can never come after you again, but you're not really done in the pension business, because we have this California rule that says all of your current city employees were promised a defined benefit pension benefit. And I shouldn't say legal things when John's here as a lawyer, but my understanding of the rule is that means each individual employee is guaranteed that, and you can't say, oh, let's put in a 401k plan and on average everyone will be the same. It's sort of a one-by-one test. So you have this, you would have to then start up a new pension plan for at least your existing employees, and that would be really difficult and really expensive. You could take your new employees and do like something low cost for them, but you're not really out of the pension business even after you paid CalPERS $2 billion. In my mind, and this is something where you can do calculations and quantify the risk, it would be way better to pay 645 and take your chances on how much of that CalPERS could potentially lose. Hopefully nothing in the long run, but it's hard to imagine having to pay 3 times that number or 4 times that number.
So let me switch to sort of the other piece of that, which is for the 645. I am curious when to disclose to the committee, I was sort of pension-wise sort of raised by Mary Beth's partner at the firm, John Bartel, who testified for me for years in all kinds of hearings and things like that. At the time, John was pretty negative on the idea of pension obligation bonds. So I'd like you to explain, maybe let's start at the beginning there, which is kind of what is a pension obligation bond maybe, and what are the risks, and how are you guys at the firm? I mean, I realize part of this is in your control and part of it's not. You're not a finance expert, you're an actuary, but I'd be curious what your take on that is.
Good question. We are at the moment, and may not be for much longer, but in the past year, we've been in this kind of funny environment where interest rates are really, really low. And so California cities have been able to issue pension obligation bonds for about 3% interest. Some of them less than 3%, some of them a little bit more. And of course, we can't predict how well that's going to last. But if you think of it in the current environment, you have the opportunity to borrow money at 3% and give it to CalPERS and hope that CalPERS in the long run is going to earn 7%. And man, it's going to be great, right? You're going to make so much money. Before the past year, the numbers were much more like borrow it 5.5 and give it to CalPERS and hope to earn 7. And that was a lot more risky of a deal. Okay, so it's the current environment that's made this very, very popular. But it's still not a guaranteed savings at all. And there's 2 ways it can go bad. Even if you do manage to borrow at 3 and give the money to CalPERS, obviously CalPERS might not earn 7%. You have to hope they earn at least 3, but that's not guaranteed either. In the long run, they could earn, well less than 7%. They could possibly earn less than 3% in the long run. And so that's a risk. There's a very short-term risk of you give CalPERS the money and man, it's like 2007 again. You took out a big bond, you gave it to CalPERS, and the next year they got minus 25%. A quarter of that money is gone. Now you still have to sort of make up that 25% of the bond money that CalPERS lost, and you still owe interest to your bondholders. And the city can end up paying much more than they would have had they not done the bond deal. So there is that risk. The other risk is very counterintuitive, and it happens if CalPERS actually does really well with your money. What happens under PEPRA is that if the plan does become fully funded, the city still needs to keep paying normal costs. There's no more pension holidays. So if you imagine a year where CalPERS earns 20% for like 5 years in a row, and you don't do a bond, now the plan is 100% funded, but the city has to keep paying normal cost. Okay. If in that same environment, the city had taken out a pension obligation bond, and CalPERS earned 20% every year, the fund would be in exactly the same position. It would be overfunded. The city would still pay normal cost either way, but if you had taken out a bond, you would have to pay the bondholders. So the city would have a worse cash flow position, even though investments did really well. So those are kind of risks in the current environment where you can borrow at 3%, most of our calculations are showing that sort of between 75% and 80% of the time it's a good deal, depending on how much you borrow and a lot of other factors. But it's not 100%. It's not even 90%. So a lot depends on the city council's, we call appetite for risk. How much are they willing to risk, and how much do they want things to be a certainty?
Are you seeing, well, let me put it this way. I seem to be seeing a number of jurisdictions, a lot more jurisdictions all of a sudden doing this.
A lot of jurisdictions that we would have just sort of thought in our gut were fairly conservative and would never think about something like this are thinking about stuff like this.
Couple other questions that have come up from folks in the committee, and then I'll give other folks time to ask questions. But one of the questions that's come up is the connection, I guess, between compensation levels and pension liabilities. And so, I mean, in a very common sense way, the final compensation in some form or another does set the pension level of the employee or some portion of it or whatever. But so commonsensically, it seems like the more you compensate, the higher the pension levels. The higher the pension levels, the more you would owe. In terms of, you know, whatever, the more your pension liability on there's no such thing as a free lunch theory. So I guess the question is you know, basically giving employees less money, for lack of a better word, less compensation, a viable way to reduce pension liabilities, and what are the limitations of it?
That's a really tricky question. I don't have any slides about it, so I'm going to turn off the slides and I can see people's faces a little bit. So I guess I would say two things. First is that a lot of the unfunded liability I kind of think of as relating to retirees, and they're done. Nothing's going to change their benefits at this point. So we can only impact the unfunded liability of the active employees. Okay, so we only have part of it to work with. You're absolutely right. Your pension is based on whatever the final pay is at retirement, one way or another, and that's going to govern the unfunded liability. And there's, you know, whatever the actuaries project is kind of meaningless because it all comes down to what actually happens. So the actuaries' calculations are projecting pay increases in the future based on what they see actually happening. And they're trying to model, they're trying to predict the future, and they're truing it up every year and trying to keep it true. And so we always get asked, well, if I give a lower pay increase than the actuaries' projections, aren't I going to save money? And it's really complicated because you can lower pay this year and it'll lower your costs next year. But can you really keep the pay that low for the rest of the employee's career? In particular, can you give a lower raise this year and a lower raise next year and a lower raise the year after that? Because employees move around a lot. There's always compensation studies being done for competitiveness to make sure that, you know, our pay is aligned properly with our neighboring cities or even private industry so that we can keep the employees we want, we can hire the employees we want. And really what we think is you might get away with having lower salaries for a short period of time or just a little bit, but in the long run, it just isn't feasible. If you have a 1% lower raise every year, after 30 years, your pays are 30% lower than everybody else, and you're going to find that you don't have any employees. Or certainly you don't have the employees you want to have. And it just, that's why it's difficult to make it happen through pay.
All right, I have more questions, but I'd like to turn, I can see everybody's getting antsy to ask their questions, so I'm gonna turn this over. Why don't we have hands raised? I see Mr. Milano, I see Ms. Wolfson. Let's start with Ms. Wolfson, because I saw her earlier.
Oh, thank you. I didn't know how to raise my electronic hand that quickly, so thank you for calling on me. First of all, I wanted to ask, and this is something maybe Michelle Flynn can answer. I just wanted to know, do we have those figures for June 30th of 2020 available? The what was 645 million at 6/30/19 and the two assumptions about the exit, just for the sake of, because I feel like we're 2 years past already. And if you don't have that right off the top of your head, that's, maybe I can move on to my next couple of things. And I wanted to say, although I agree theoretically, it should be the case that our returns should be better from CalPERS because they don't get a profit motive or they don't have a profit. Their performance just is not that stellar in my mind, and it's very odd to me. And so when we assumed that, I'm not sure why we assumed that we would get a better rate of return from them than we would elsewhere. The other thing is, I'm wondering about that 7% of interest rate they charge us and how they get away with some of this stuff, these kind of fiats. They seem like edicts, and it seems very unfair. Like you mentioned that if you shorten the term of your mortgage, you get a little sweetener in terms of a slightly lower interest rate. Well, why shouldn't the city get some break from CalPERS? I just don't understand why there's such, they're so immovable in terms of not working with member agencies. I don't know if you want to address this first, and then I did have a couple of other things, but go ahead and.
Okay, I'm going to tell you that I'm trying to find the slides in my head. I had put on the slides we looked at last week, the unfunded liability as of June 30th of 2020. I didn't write down the termination numbers. But after that, CalPERS had the really good investment year. And then just this afternoon, the board reset the discount rate to 6.8%. So even the June 30th, 2020 numbers have changed quite a bit since then. So I'm just using all these numbers as kind of order of magnitude. The reason they charge 7% interest, well, it'll be 6.8% interest going forward, is because they have to charge the rate that is set by the board as the discount rate.
The board. Yes. Yeah.
That was the two questions, right?
Yeah, so then let me just bring up one other thing. With respect to pension obligation bonds, I wanted to mention something that concerns me about them in particular. Besides the fact that they seem to be sort of another way of burdening everyone in the city with interest and debt, that's, in a very risky kind of way, it seems to me, because I'm not, even if you're paying 3%, and I think interest rates are going to go up because we're in an inflationary situation at the moment. Even if you're paying 3% to your bondholders, and even if CalPERS makes 7%, by the time you pay off the debt and the bond, you're just going to break even. You're not going to really end up ahead. And second of all, I always worry about refundings, because a lot of times if you issue bonds, they can be refunded by the bondholders, and then you're kind of at square one again, and it's just a big mess. But I did want you to, if at all possible, because I do think that some members of the public may have some confusion about the difference between the pension obligation bond, which I happen to agree with GFOA about, and I don't think it's a good idea. And the irrevocable trusts, because I think for some people, they may feel like that's kind of the same thing, which clearly it is not. So if you wanted to talk about that just a little bit, maybe.
Okay, so just really quickly, the pension obligation bond is a way of borrowing, going out to the market, borrowing usually relatively a lot of money, like $645 million. You probably wouldn't want to do the whole thing, but a big amount of money. And then your promise with the borrowing is that we are going to use this money to pay off our pension debt. And so you take that money and you give it to CalPERS. And you're betting that CalPERS is going to invest that money and do well with it. Okay. The Section 115 trust is the city sets up that trust to hold money until the city decides it's a good time to turn that money over to CalPERS. And it can be it decides it's a good time. But that's a thing to do with money that you've gotten through some way that we haven't really specified. The POB is a way to get money, and it has to go. If it's a pension obligation bond, it has to go to CalPERS, is my understanding.
Thank you.
If I may, Mr. Holtzman, I can address Ms. Wolfson's first part of her question.
Sure, that'd be great.
The updated numbers from the reports that we received this year from CalPERS, the range is anywhere from 2.7 to 3.7 billion in the termination liability, just depending on the interest rate that is used. They did drop the low end of the interest rate. I think Mary Beth's presentation shows 1.75% as the lowest.
Yeah.
Now it's 0.75.
Yeah. And that's because they base it on essentially the 20-year. It's not quite exactly right, but basically the 20-year T-bill, and it's actually an average of the 10 and 30, so it's very confusing. But and it's a weighted average, makes it even more confusing. But it was down at 1 last I checked.
And the UAL at 6/30/2020?
It's 640 million.
640.
Yes.
Okay, thank you.
Mary Beth, that is what you had, right, in your presentation?
I had in the two pieces and I couldn't see them both at the same time
That's
to add them.
Those are the numbers that are in our annual financial statements.
Okay. Yeah, I adding the two, it looked a tiny bit higher, but it's still in that range.
So when we get the report from CalPERS, it's done earlier, it's in the summertime, and then they give us the GASB 68 report for the financial reporting. So it can vary slightly. So
Okay.
the number that we utilize in the financials is what's in the GASB 68 report from PERS.
Okay. Other questions? Mr. Milano.
Thank you. I have a comment and several questions for which I need some clarification. I was just looking up for comparison purposes, what would have been the return for 20 years from Berkshire Hathaway? Actually, if you go back to 1965, if we were allowed to invest in Berkshire Hathaway, it would have been 20% compounded interest for the last 40 some odd years. The last 20 years with CalPERS, about 4.5%. Not counting this last unusual year, but 20 years, 2001 roughly, from the year 2020. So it concerns to me that as CalPERS moves into these speculative investments, if we were to borrow money to then pay to CalPERS and have no say-so as to how they're going to use it, yeah, it's very likely that we may use a good chunk of that and all that additional debt is for naught. And the government financial officers website has an interesting comment regarding that. And the comment basically tries to dissuade cities from doing so. It was one of the documents that I wanted for us to discuss today or soon thereafter in the future meetings. So here's my question. With a supplemental trust, the what is it, the 115 separate or the additional trust? Okay. Can the city set aside this money for the purposes of having sufficient funding in the event that the solution is layoffs? So we're still in the hook for all of that pension obligation, but we're putting money aside to make sure that we are supplementing to some extent to have a base by which we can start doing a significant effort at reducing the number of employees or changing the compensation schema. So for example, if the city were to say to managers and people earning over 100,000 that we now go to a 4-day work week, in other words, reduce it by 20%. Their pay per hour is not going to necessarily change. Their total compensation change, and our total pension obligation would also significantly improve. So can this 115 trust be used for that purpose?
No. It can only be used for the CalPERS pension obligation. But the whole point, but part of the point of that trust is that you want to set money aside for a while because you're trying to invest it. So it's not clear to me that you would really want to use that tool.
The other question that I had is with regard to your background. I really appreciate your presentation and the tone that you gave it. But with regard to your statements concerning that it isn't feasible to say put a cap, I'm not suggesting that there be a reduction in pay, but if I were to suggest that there'll be put a cap, does your background allow you to give us a reliable indicator that the city would have problems finding the right employees in the future?
Okay, so I probably should have qualified that or let one of the cities speak to it. But our experience is that when we have seen other entities try to cap pay or try to do things that really reduce the take-home pay of their employees, they end up having major labor issues going forward in terms of hiring and recruiting and retention.
Thank you.
John, you've got a couple other questions, I think.
Thank you.
Am I going to talk, John?
There you go. Yeah. Sorry. Yes, Mr. Macias.
Yes, I have at least two questions. With the trust, it stated that there were preset allocations that the investments have to be. One was 22% equity, and I think the other one's 48%. Why is that?
Let me bring that page back up. Sorry, get out of the way.
And conversely, I would agree just with Ms. Wolfson that there being a profit incentive for, a portfolio manager would probably actually be better than utilizing CalPERS, because we've seen their investment history over the last 20, 30 years and how it's, statistically and always, underperformed the market. And the 1 or 2 years that you point to are years that everyone would have done well if you just thrown a dart at the table.
Okay, so let me talk a little bit more about what's the information on this page. There's 3 big providers at this moment. The biggest is PARS. So they give you a choice of one of 5 investment funds that are sort of go from like an 80-20 to a 20-80 stocks and bonds mix. PFM tends to do more individual trusts, Keenan sort of individual stuff. These 2 strategy 1s and 2s are the 2 that CalPERS has decided to offer, and they're deliberately very conservative. CalPERS decided, or I think their board decided that people would be driven by not wanting to lose this money and would want to be conservative. So that's your choices if you want to go with a pre-set up trust. And a lot of cities are putting little bits of money into this. So if you're putting $100,000 into one of these trusts, you want to go with a pre-made trust. If you're putting a lot of money into a trust, you could build your own trust. I mean, at that point, the setup fees are not a big deal. You could hire your own investment managers. You could do whatever you wanted. It doesn't make sense if you're just setting aside little amounts of money. Did that answer your question?
It answered. It looks like CalPERS is, purposely trying to be punitive for any city or entity that's trying to move away from them with setting up these predetermined trusts. Because as you said, as a city of Glendale, if you put a couple $1 million, there will be dozens of portfolio managers and investment companies that'd be more than happy to provide, top of the line investment strategies. And then my second question, just real briefly, I don't know if it's appropriate for you, we run the numbers that an average person could only put away right now $19,500 in a qualified account in a 401k. Looking at the defined benefits that these city employees make, it would almost be that they're able to put aside more. And so, my question is, earlier I heard someone saying that a employee who made 100,000 was putting around 33%. Is that true? So does that mean they're putting away $33,000, or is it 33% of their defined benefit portion? I know it's a little complicated because it's very technical.
I think the way I interpreted the statement that was made was that an employee earning 100,000 is paying about 1/3 of the cost of their benefit.
Okay.
But they're not paying 1/3 of their pay.
But
got it.
But the amount that's being put aside, not by them, but in toto, including the city, if you're let's just say you make $100,000 a year. In toto for a miscellaneous employee, you're going to be looking at, roughly $33,000 or something like that, or maybe more even, maybe $40,000 going into the pension trust each year on behalf of that employee, in some combination of the employee paying and the employer paying. So they are putting, doesn't pay, it's not a defined contribution, so it doesn't work quite the same way. It just goes into this big thing. But yeah, you're effectively putting more money is being put aside than, $19,000 for a $100,000 employee.
Thank you for clarifying.
Do you have that right? I mean, I'm not sure it's the right way to put it, but I mean, the actual cash that's going in.
John, the way that Mary Beth described my statements was actually accurate. About 1/3 of that individual employee's pay is covered by that individual employee through their own cost share.
Right.
So it sounds that we're greatly overpaying for employees for their retirement accounts. Because if the average person is only allowed to put 19,500, which most people don't ever do, then, we're offering a great benefit to people who work for the city, plus the actual, net income from people. So I find it hard to believe that we would have a hard time finding employees. It just seems like government employees just have an inflated labor market compared to, private employees.
So I think the clarification needs to be they're not contributing 30% out of their paycheck. They're contributing towards 30% of their benefit. So
yeah, that makes perfect sense. So, if a $100,000 employee gets a $30,000, retirement, benefit per year, then they're putting away $10,000. So they are netting out far more, about 30% more than what a typical worker can. Because, me working in private could only put away $19,500. And then if you're including a 4 or 5% match from my employer at $100,000, then, I'm only able to put away $23,000 or $24,000. So I'm just trying to make a point that, government employees are making out like a bandit when it comes to their retirement benefits, plus the net income pay that they take home because they're only paying 1/3 of that 30%. And so I see, some cost savings on lowering these benefits or lowering the net income one way or the other to kind of make it in line to, private employees.
Well, I'm sorry, Mary Beth. The 19,500 is the contribution limit for the deferred for your deferred compensation, which is a defined contribution plan.
Correct.
That money then goes into investments and earns money in order for you to have a benefit down the road, right? So similar to the PERS contribution, when we say the employee contributes about 30% of their benefit, that includes those earnings that they're going to accumulate on that money down the road. That makes sense.
No, I definitely understand, Michelle.
Okay.
I'm a wealth advisor by trade, so I set up both defined benefit plans and defined contributions.
Perfect.
And I've also worked with, public school teachers on, city employees don't have to pay into Social Security. Their benefits far outweigh what an average citizen. So I'm just trying to find a balance here that, all right, you don't have to pay Social Security. You're only paying $10,000 into a $30,000, benefit retirement plan. And I just see a little bit of cost savings there. And I'm kind of interested in with the trust and how we have a predetermined allocation, which purposely hamstrings city entities and kind of, going their own way or saving money.
And I can address the city's Section 115 trust at any time, Mr. Holtzman, if you'd like me to.
Michelle, why don't you, talk about that? Because I know you have one.
Give some perspective. Okay. So in 2017, City Council adopted and allowed us to go ahead and move forward to set up a Section 115 trust. Section 115 is basically the IRS code section specific, as Mary Beth indicated, towards pension benefits. Our provider is PARS. At the time, they were the one that had the private letter ruling from the IRS that allowed for basically to say that this is all, kind of on the up and up with the IRS and how we're supposed to handle it. So we went ahead with PARS. They have investment manager called Highmark that we utilize, and we invested $26.5 million in the trust at that time. Since then, we did add another $5.5 million a couple of years ago, and our trust balance right now is just shy of $41 million. So our annualized net return is about 6%. Since inception. The funds are in what PARS offers as a moderate portfolio, where it's about 52. Let me give you the exact numbers as of September 30th. Equities is about 52.5%, and fixed income and cash is the remainder. So it's similar to that one strategy that you saw on Mary Beth's slide that PERS offers. PERS only offers those two strategies, but as Mary Beth indicated, PARS offers multiple strategies. And we've decided, along with City Council, that we wanted to do a moderate investment strategy to basically safeguard the money, but still earn more than what our city treasurer can invest, because he's very limited with the state laws on very low interest earning account options right now. So we're definitely making more on the trust than the city's portfolio is making. So the idea of the trust is obviously to draw down on that at some point, to continue to maintain our reserve levels at what City Council has adopted at a 25% floor in the general fund. So we're remodeling all of that right now. I have my budget team working on that so that we can have a robust discussion once this committee concludes with their findings and as we go into budget season in the spring. So that way they'll have some good ideas on when we're looking at probably having to pull down on some of that money to help shave off the peaks of the curve for the interest rates. So I can answer any questions on the 115 We've also done the additional payments as Mary Beth suggested as well too. We've done that a couple of times.
I think we have Mr. Kadikian.
Thank you, Mr. Holtzman. I may be an outlier here amongst the people. Everybody is so enamored or scared of the 2.8 billion that is quoted by CalPERS. But my question is, CalPERS doesn't have any obligations or duties to us, the taxpayer. And I'm not sure why do we have to accept numbers that they ask for? Is it because their prior history in providing numbers is so reliable? I mean, they did say in 2000 we were super funded, and we were not, or as it turned out. And then they stretched us for 3, 4, 5 years with deferring the payments, which made us into a bigger hole. But of course, it subdued the cry and protected their members. So I'm not sure how much trust we should put in any number they provide, which brings me back to the original request that I requested is, does CalPERS have any legal basis to ask for everything up front, one, and those numbers that CalPERS is asking, does it have any legal basis, two? So before we decide, okay, terminating from CalPERS is impossible because it's 2.8 billion, let's just check and verify their demands and whether they're viable legally, defensible, challengeable by us before we just decide, okay, that's not the direction we could go. I'm okay in that direction as long as we analyze it fully. I don't want the same mistake that happened in 2000 to happen now. That's all I'm asking for. So with that, that's why I asked for a complete CalPERS agreement that we have currently. And I also asked for an expert to come in and go through the contract and say, this cannot be challenged because there's this case. This may be able to challenge. And if you do, you're going to get this kind of result. And let's give this to City Council instead of us telling them, that's too much money, 2.8 billion. So our purpose here, the way I understanding, is providing them options, not just simply provide the staff report and giving them something to choose from. So that's my comment about terminating CalPERS. I want to be convinced that we cannot. The 2.8 billion, I'm not buying it from CalPERS if it's their number.
I'm gonna think about how to provide you that assurance. I litigate this stuff myself, but I'd rather not be. I'd rather there be an independent person, although I'm not especially beholden to anybody. But the very short answer, but we'll see if we can get you a longer answer, is CalPERS. We sign a contract with CalPERS. Essentially, it says we will abide by all of CalPERS's various rules and all of that sort of stuff. And they have remedies, obviously, all kinds of interesting remedies. I don't know, Mary Beth, anything to add to that? I'm thinking about where the right place to go to get a more aggressive opinion on this than from me. And Mary Beth already thinks I'm an aggressive madman, so I'm trying to. Is there anybody out there who's more aggressive than me?
I would have probably said call John Holtzman, and he will tell you it can't be done. But so I know this is not a good answer, but just about, well, maybe not. A very large number of cities and public agencies would love to get out of CalPERS and have been trying very, very hard to figure out a way. So I don't want to say that you couldn't possibly think of something they haven't, but I know that the particular issue of the withdrawal liability has been thought about a lot. But nonetheless, John, you probably would be better at recommending someone.
I'll have to think about it. I mean, the best argument that we were able to come up with, Mary Beth knows about this because she was involved, was we asserted that that the interest rate, the discount rate that they were applying to the termination pool was unreasonably low, which doesn't go to the broader issue of just rejecting what they're saying. It was a sort of a different theory, and that was a very challenging theory. It was in a particular case, and we were able to make a little tiny bit of progress with CalPERS, but that was because of an unusual set of circumstances. The argument, if you want to make the argument that the discount rate for the termination pool is unreasonably low, the kind of simplistic argument is if you look at the funding of their termination pool, it is insanely superfunded, meaning that the very few people who are in the termination pool, as to them, they've been earning a great deal more than sort of they should have been earning. But the comeback to that, as Mary Beth would be quick to tell you, is because she and I have these debates, yeah, that's true for now, but you don't know what's going to happen in the future. You also don't know what's going to happen when you get more people in the termination pool. So that's been the best argument that I've been able to come up with, and the argument really goes something like this. It may have made sense for CalPERS to base the discount rate on termination on the average of the 10 and the weighted average of the 10 and 30-year Treasury bills when they were making 3%, because 3% in my mind sort of approximated a risk-free return. When you're down at 1%, the fact of the matter is there are an awful lot of returns that have very, very, very low risk that make 1% or a bit more than 1%. So that was sort of the argument. So there are, that's the argument that I kind of worked on. And again, I was able to get a little bit of distance with CalPERS, partly because from the time CalPERS gave us an estimate of what the termination cost would be to the time we actually terminated, which was a year, the discount rate had fallen very, very sharply. And so we made the argument that that was unfair. But to your more broad point of, just simply telling CalPERS to pound sand, I'll see what I can do with it by way of lawyers, but I think that the best argument that I can think of, the problem, the obvious problem, aside from the fact you have a contractual obligation to CalPERS, is what they would do is they would take it out of the hides of your employees. That much we know because they've done that.
Do they not have an option to go after city assets?
Yeah, and I think that's what they would do, is they would sue for the city assets, and I think they do have that ability as well. So I don't know. Let me work on it a little bit. I'll see if I can get you a more satisfactory answer.
Thank you. An expert or somebody who could talk about those chances and possibilities would be very much beneficial, because the number of 2.8 million, that's the money that I see that they would think would keep us and every other city in CalPERS, because ultimately we are the clients and they don't want to lose us. So that's how I see that number.
Yeah, no, I understand. And that you're not the first person to suggest that the termination rates, et cetera, are intended to discourage people from terminating. It's a very common statement. So you're not alone in that thought. Let me work on it.
Okay, thank you.
Okay. Let's see. We have Mr. Milano, but I want to make sure everybody else has had a chance before, if there's any, because Mr. Milano has asked a couple of questions. Any other hands? If not, I will call on Mr. Milano. Okay, Mr. Milano.
Thank you. Well, I am extremely troubled by the whole structure. It is even worse than what I initially expected, even after all of these years in looking at the CAFR and following the increasing debt. It seems to me, and it's my opinion, probably shared by many people, that CalPERS is a dishonest player. They've protected themselves with legislation around them, maybe even up to the California Constitution. They are not responsible for losses. Their compensation is not even tied in to any potential losses that they may have. They get continual pay increases, the administration does. And I was reading one of the critics who was a board member of CalPERS, basically implying the very same thing. Increase incredible compensations to the people who are running CalPERS. They are protected in such a way that they can speculate as much as they want. Any losses they're not responsible for. And yet we can't seem to get ourselves out of that particular predicament, because it seems like the function of a city is no longer to serve the residents. It seems like the primary function of city government, of the city of Glendale, is the pension obligation and the city employees, period. And that's why I want to put all of these discussions in the future soon in context of how much deficiency we have had to bear as a result of this increasing obligation, right? And the funding that is requiring every single year. I'm incredibly troubled because it seems to me as if we're being guided to this one area where even the Governmental Financial Officers Association talks against it. They say, issuing taxable debt to fund the pension liability increases the jurisdiction's bonded debt burden and potentially uses up debt capacity that could be used for other purposes. And then he goes on to some other constraints that the city may face. We may face economic situations or climatic situations where the city might need to issue bonds in the future, and we're going to be chokehold by an additional debt obligation, that we may come up with in order to pay this additional debt. So if we don't address the pay of the employees, the structure of the pay, the years of employment, the amount of earnings that they're making on their last years, because there seems to be no relationship between what is being paid every single year in both contributions and what the city paid, because unlike Social Security, I cannot tell the government, oh, wait a second, my last pay was $140,000, adjust my pensions to what I made last year. Social Security doesn't do that. It goes back to all my contributions going back since I started earning. So let's not compare the pension system to the Social Security approach, because it's simply false. The whole idea that I tried to calculate, figuring out what was being contributed year to year, allowing for inflation and investments, has no relationship to what is actually being given to the employees when they say, we're going to give you the average of the last 3 years, no matter what happened in the past. And so, and on top of that, we have investments for which we have no control over. So CalPERS can lose as much money, bleed as much as they can, and the taxpayer is still on the hook. This is a horrific dilemma. And then there are wraparound concentric circles of legality. We've been suckered into a system that is atrocious. And then on top of that, we get claims that it would be impossible to get any other kind of employee that is professional enough to be able to handle the tasks that the city demands. So we are basically saying, well, we can't do it because we can hire employees. Every way we turn, there doesn't seem to be a viable alternative to getting rid of this problem. And that's why I think that we need to put this in context with regard to the whole impact that it has done to the city. I cannot get my streets repaired for 40 years because there is not enough money to fund street surfacing.
Okay,
It's incredible.
I hate to cut you off, but Mr. Manning has been waiting.
Thank you.
I just wondered what Mr. Milano's question was, because I didn't hear a question.
Yeah, I mean, I appreciate the frustration, which and this is a very, very tough area. I mean, we wouldn't be here. You know how many people are working on this problem? So it's a very, very tough area. But I agree with Mr. Manning. So let's remember we have Mary Beth here for only a few more minutes. So if there are questions, I appreciate that. Ms. Wolfson?
So, Yeah, I just wanted to ask, because it occurred to me, and I agree, CalPERS, and they're not very transparent. I don't want to get into that and waste time. But I was wondering, why can't multiple cities band together to negotiate better terms or to sort of form a united group? It seems like one city is powerless against it, but that's my question.
Well, I'll take part of that question. I mean, so there are legislative things, and we are going to get to that, by the way. That's another piece of what we're going to be covering at some point. There are legislative actions that could help. I don't think they're going to help at the level of, I mean, CalPERS has a lot of independence, so you can't just sort of legislate the rates will be X and Y or something like that. But there are legislative fixes that are possible. There are constitutional fixes on the issue of, I mentioned this earlier, the Constitution amazingly makes cities, makes people who participate in CalPERS, the agencies that participate in CalPERS, CalPERS has no fiduciary duty to them, even though they have a fiduciary duty to the members, the employees, and the retirees, et cetera. And so, which is a terrible thing. Historically, there has been a lot of frustration among cities with CalPERS's, failure, or perceived failure, at least, to listen to, concerns and perspectives. I would say, in partial defense, though, CalPERS, probably the best argument of all has been that the discount rate has been too high. And one of the reasons why CalPERS has not lowered it more quickly is because they also understand that they don't want to bankrupt the people who are paying. So I think we're going to have CalPERS come, and we'll have a critique of CalPERS come. I haven't figured out who that is just yet. But there are plenty of critics, obviously, of CalPERS, and it is the issue is, in part, that it is true that individual cities don't necessarily have that much power. That said, CalPERS has a board. I've been very involved in efforts to persuade that board on various issues, and I will say, in fairness, that when cities show up en masse as opposed to individually, that they can have an influence. So I think it's very, very. I mean, you raise a very important point, which is that to the extent that there are recommendations that this committee comes up with and that become a rallying cry for other folks and who they can rise to, I think you can exercise some influence. Mary Beth?
And there's also, I'm sure the city's a member, but there's the League of California Cities that is always a very vocal entity in CalPERS's negotiations.
Yeah, I just want to say one more thing, because it's not like it's the people of the city against the employees or whatever. I just want to make that really clear. I mean, the employees and there's a commingling. It's not like it's us against them. But I do feel sometimes that CalPERS is very dictatorial and rules by fiat, and it's not right. Well, I could say more.
Yeah,
but
I can tell you that there's certainly, again, you're not alone in that view. All right.
John, can I have one more minute? Because I realized I didn't say something important that I should have said in the presentation.
Please.
I talked a lot about, you can give more money to CalPERS, you can set up a 115 trust. The city does have the option to just not take any action. I showed you projections of costs. If the city is comfortable with where those costs are going and that they can fit into the city's budget, the city doesn't have to do anything. And so it's really the third option is just pay the CalPERS bill when it comes. We know we'll pay more interest, but it's okay. We're okay with that. And that's an okay choice.
Okay, I think we should proceed to, we have a few more minutes, I think. What do we got? We have 6 more minutes. We could proceed to the next item, which is proposals on, I believe, on other topic areas. Sorry, let me find my agenda. Would you, Vlad, would you call that item?
Item number 5, reports. 5A, committee member submissions.
And let me actually just, I forgot to thank Mary Beth. Mary Beth, thank you so much. Yes, we really appreciate all your guidance, wisdom.
Thank you. It was a pleasure to be here.
So, ideas for future presentations. Mr. Kadikian.
Yes, Mr. Holtzman, it's the second part of the email I sent, which with regards to the efforts of San Diego in dealing with their pension and Proposition B that they passed, and the different the results. Maybe somebody could talk to us just to get a perspective of more of legislative options that we can pursue as well within the city. And the details are listed in my email number 2.
I understand. Okay. So here's the challenge. I'm obviously, I think we want to hear reform ideas. One thing that's important to understand, though, San Diego is an independent system, and San Jose, independent system. It's another place where there's been, significant reform efforts. That doesn't mean it's irrelevant, because the reforms that they thought of are obviously things that, could potentially be viable, let's say, in CalPERS. It's just that the route would be you'd have to go through the state legislature.
Okay.
Let me look at somebody who can speak to other reform efforts.
I was just gonna, am I unmuted? Yes.
Okay.
I was just gonna say I liked Mr. Kadikian's suggestions, and I don't know, are you saying that San Diego is not in CalPERS and
They're
San
not.
Jose is? Okay.
They're not. They have their own system.
Okay, then that does make some difference, but he also had, I think, brought in the Reason Foundation, and I had found them that, maybe I don't know whether they would be able to help us or not, but it seemed like they might have some ideas.
Yes, and also the representative for the for the Glendale Fighters also indicated and discussed Proposition B in our first meeting, which I think you were aware of it as well.
All right, Mr. Bain.
Yeah, one of the items that I think wasn't mentioned is the difference in assumptions between the ongoing plan and termination, is that CalPERS is shifting from merely a custodian of taking the assets and paying benefits, whatever they do turn out to be, and trying to approximate how much money to put in, to becoming the insurer of those benefits. So once you withdraw, they become on the hook, and they want this amount of money, and they're promising to cover the benefits at that point. So that is significantly different. And those low assumptions are very similar to what insurance companies use to guarantee annuity benefits. So I don't find it particularly odd that there is that discrepancy. It's a matter of understanding and why they are not giving the option of freezing future entrants or freezing benefits, giving, some way, as private plans do all the time, of giving you an option of continuing to fund your own liability, but not increasing it.
So that's a good discussion to have, whether they can shift by themselves without giving us an option to do something about it.
So again, I mean, this goes to the CalPERS rules and the ability to challenge them. So I will try to, I'm not quite sure who the person is for that. I'm gonna do my best to find somebody.
Because if they want to go in that direction, that might be an opportunity for us to disengage.
I'm sorry, I'm not sure I understand.
Well, I mean, if they're going in the direction of being an insurer as well,
Oh.
well, maybe that's an opportunity for us saying, we don't want to go in that direction. That's not what we agreed to.
All right, any other, I'm sorry, my wife just came home, so the dog is going crazy here. All right, well, one last comment, Mr. Milano, and then we'll call it.
Today, we addressed the issue of what options do we have going forward. Assuming that the structure under PEPRA will continue unchanged. And if we do not understand or impact the process by which the city determines its MOUs, if we don't address that, then we pretty much are solving only a portion of the problem, meaning the problem that is already underwater. The other thing that is important, I think, for the public to know is that we need to put this discussion in the context of what the purpose of a city is. Because if we don't, we are not telling the public how this impact is impacting their daily lives and their quality of life. So two things, the process and the context is what I'd like to bring to the future in discussions in these meetings. Thank you.
You're muted, Mr. Holtzman.
I'm sorry. Do we have a motion to adjourn?
I motion.
Second.
Second.
Okay.
And we're adjourned at 8:31 p.m.
All right. Thank you, everybody. We'll see you in 2 weeks.
Thank you.